Stop crawling for a second, because if you are a business owner who builds, tests, or improves anything, you're about to miss out on one of the biggest tax wins of 2025. That's right, every dollar you spend innovating inside US can now be written up immediately. No more waiting 5 years, no more slow dripping deduction. You can take the full write-off in the year you spend it. And the best part, this change isn't just the tech giants or scientists in each code. It's about everyday innovators, contractors, manufacturers, software builders, designers, even local small businesses testing new systems or recipes. Hi friends, it's Mia, and today we are breaking down how this brand new tax law from the Big Beautiful Tax Bill of 2025 bring back R&D expensing in US businesses. So let's talk about why it matters to you, how it works, and what steps you can take today to turn your idea into tax deduction. Before we jump in, this video is for educational purpose only, not tax or legal advice. Everyone's situation is different, so check with your tax pro before you file. Let's start with a real life story, because I know you love to see how it plays out in the real world. Ms. Kai from Engineer Success LLC, an engineering firm based in Honolulu. Kai and his small team design packaging equipment for local food manufacturers. Every year, they test new eco-friendly materials and experiment with machine prototypes. In 2024, they spent around $80K in wages, supplies, and testing, all of it done right here in the US. Before this new law, they had to amortize those costs over 5 years. That means spreading over deduction and waiting each year to get a little tax benefit. But under the new Section 174A from the One Big Beautiful Bill, they can now expend the entire $80K in one shot for 2025. The one change freed up cash immediately, so Kai used it to hire 2 new engineers and buy faster testing equipment. See how that works? That's real money back in your hands. Now, let's look at another one. Lani from Coastal Bakery Innovations run a local bakery in Ever Beach. She wanted to automate her proofing and baking lines and spent about $30K in testing new machinery and working with a local design firm. Before this law, those expenses would have been stuck in her book for years. But now, that $30K is fully deductible this year. And because she also brought new ovens and equipment, we stacked that deduction with bonus depreciation. Another Big Beautiful Tax Bill win that let you write up 100% of qualifying equipment placed in service after January 19, 2025. She got a double deduction, so one for R&D work and one for hardware. And that's why this update is such a big deal. Let's take a quick pause. If you are still watching and you already have ideas swirling in your head about projects you could write up, hit that like button right now so YouTube knows to show this to other small business owners just like you. Alright, now let's dig into what actually changed. What changed under TOB3, which is the Big Beautiful Tax Bill? Starting with tax year beginning after December 31st, 2024, U.S. research and experimental R&E expenses can be fully deducted in the year they are paid or incurred. That means if you spend $50,000 this year developing a new process, improving your software, or testing a new product, you get the entire deduction in 2025. Before this law, you have to amortize, which simply means spreading that deduction over 5 years. Now that's gone. But, and this is a big but, this only applies to domestic R&D. If you do your research overseas, the old 15 amortization rules will apply. So, If you are working with contractors abroad, only the U.S. portion qualifies for immediate expenses. That means planning matters, and we will talk about how to ship more of your R&D back to the U.S. in just a bit. You can also choose to amortize domestic R&D over 60 months if you want a smooth income, but most small businesses will take the full deduction up front. And here's something that might surprise you. Small business can even go retroactive. If you had R&D expense from 2022, 23, or 24 that was amortized, you may be able to deduct the remaining balance in 2025. That's like getting a refund from the past 3 years. But you have to plan it right and file it correctly. It's pretty cool, right? Now that we know what changed, let's talk about why you should care. Because if this sounds like just another tax law update, you are missing the point. This is a cash flow law. When you take the immediate deduction, you keep more of your cash today. So that means more flexibility to invest, expand, and grow instead of waiting 5 years for your money to trickle back. Imagine you spend $100K developing new software. Before 2025, you would then only get 20 grand a year deductions. Now you get the whole 100K this year. So that potentially 25Ks or more in tax saving in April. That's why this matters. It's not about paperwork. It's about keeping money where it belongs in your business. So let's go step by step and talk about how to actually make this work for you. Step 1, track and tag every R&D cost. This is where most people messed up. They don't know what counts. Let's break it down. Starting by tracking every single cost tied to research, testing, or experimentation. So that includes wages, the portion of your U.S. employees spend time building, testing, coding, or improving products. Supplies, like material used up during the experiments, things like prototypes, test ingredients, or sample runs. Contract labor, so U.S. contractors helping with qualifying work like testing, prototype design, or process development. Software and tools. If you are developing or testing system internally, those costs count too. Now, create a spreadsheet with columns for date, description, cost, location to U.S. or foreign, and category. If you are doing some of the work abroad, mark it clearly so you can separate it later. The IRS wants you to prove you knew what was domestic and what wasn't, so label it now. A simple label like R&D U.S. labor or R&D U.S. supplies can save you from a tax nightmare during tax season. So that's the foundation. Now let's talk about how to separate what counts, and what doesn't count. So step 2, you want to separate domestic from foreign work. So this is important because your US-based research qualifies for a full write-up. Let's say you have a small development team in Texas and another in Philippines. You can immediately expense the Texas work, but you still have to amortize the Philippine portion over 15 years. That means you should plan where you do your testing. If possible, ship core experimentation back to the US. Things like concept testing, trial builds, or prototype refinement. You can still use your foreign team for follow-up or scaling, but keep the real, uncertain, or experimental work in the US. That's how you keep your deduction front-loaded instead of delayed. Once you have sorted where the work happens, the next decision is when and how to take the depreciation. Step 3, decide immediate expensing or amortization. Now, most businesses will take the full deduction now, and that's usually the right move. But sometimes it's better to spread out. Why? Because tax strategy is about timing. If you expect your income to spike the next year, you might save more long term by spreading the deductions and smoothing your income. Think of it like this. Do you want one giant deduction this year or a smaller, steady deduction that match your income flow? Kai from Engineer Success ran both options, so fully expensing gave him better short-term cash flow, while amortization would have given him smaller savings over 5 years. So he chose full expensing because he needed that cash now to scale. Now that you have chosen your deduction method, let's talk about how to make the most of it by pairing it with another major benefit, the R&D tax credit. So step 4, you want to coordinate with the federal R&D credit. So this is where the magic really happens. The R&D credit is a completely separate benefit from the deduction. While the deduction lowers your taxable income, the credit reduces your tax bill directly, dollar for dollar. And yes, you can do both. It's not, but not on the same expenses though. So you have to allocate wisely. For example, if you spend $100,000 on qualified R&D, you might deduct $60,000 and claim a credit on $40,000. So you could deduct all $100,000 and skip the credit. It depends which option gives you a better overall result. This is where your accountant earns their keep. Modeling both options can save you thousands. And remember, documentation is everything. If you ever claim this credit, the IRS will want to see proof of what you did, why it was experimental, and what the result was. Step 5, you can stack it with equipment write-up. If your research involves buying physical tools, machinery, or lab equipment, don't stop at the R&D deduction. Under the same law, 100% bonus depreciation is back for qualifying equipment placed in service after January 19, 2025. That means you can write off the cost of the work you did and the equipment you used to do it. For example, Lani from Coastal Bakery deducted $30,000 for testing and design work, plus full depreciation on the new ovens she installed that year. So that's double win, and this is fully legitimate. Now that you know how to use the rule, let's talk about how to make it even more powerful with future planning. Step 6, plans for 2026 and 2027. Here are some advanced moves that you can do. If you think this is just a one-year opportunity, you want to think again, because this is your chance to plan 2 years ahead. So tip number 1, so income smoothing strategy. If you're expecting a big profit in 2026, maybe from a new contract or a new sale, you might hold some deductions by choosing amortization. This way, you keep steady deduction instead of using all in 1 year. Tip number 2, keep work in the US. So foreign research still get 15-year amortization, so plan to keep your innovation pipeline domestic, or at least the part that involve technical uncertainty. Tip number 3, schedule big purchases before year end. If you want deductions in 2025, make sure the R&D work or equipment purchase happen before December 31st. Once the calendar flips, that deduction ship into next tax year. Tip number 4, coordinate with your QBI deduction. If you are an S Corp or LLC, big deductions reduce your pass-through income, which could lower your 20% qualified business income deduction. Sometimes it's smart to leave a little income on the table to keep the QBI sweet spots. Tip 5, watch for state rules. Because some states haven't adopted the federal R&D expensing rule yet, you might still need to amortize at the state level or add back that deduction. So check your state's conformity rules, or you could be surprised coming April. Okay, we have covered a ton, so let's keep this home with a few bonus planning tips and some practical takeaway. For bonus, you can turn your tax saving into growth. So bonus move number 1, reinvest the refund wisely. When you get your deduction, don't just spend it. Use that cash to reinvest. Buy better systems, start a new project, or max out your retirement plan. Bonus move number 2, you want to automate tracking early. Use simple tools, even Excel or QuickBooks, to track your costs as R&D from day 1. Waiting until tax times means you will miss deductions. Bonus move number 3, you want to review annually. Every December, sit down with your accountant to project your upcoming R&D spending. Plan whether you will expend or amortize. This keeps you strategic but not reactive. Alright friend, here are your takeaway. The Big Beautiful Tax Bill brought back full immediate expensing for domestic research and development. If you are innovating, whether that's building a new tool, improve your process, or testing something fresh, you can write off the cost now. So that money in your pocket today. If this helps you, hit the like and drop innovate in the comments so I know you are part of the builder crowd. And subscribe, because the next video we will talk about how to stack this with the R&D credit and bonus depreciation for maximizing tax savings. Let's keep building smarter and make innovation deduction again.